This is Bite-Sized Business, the channel where we take company news and reports and simplify it down into a few important metrics and ratios to determine a company's financial health. In this installment, we will be taking a bite into Restaurant Brands International. The starters. Restaurant Brands International was created as a result of a merger between Burger King and Tim Hortons in 2014. Burger King, their oldest brand, was founded in 1954, and Tim Hortons 10 years later in 1964. In 2017, the company bought Popeyes for $1.8 billion, and in 2021, they bought Firehouse Subs for $1 billion. The company is now headquartered in Toronto, Canada. They have over 30,000 locations worldwide, and the company's signature dishes are Tim Hortons coffee, the Whopper at Burger King, and the Popeyes Crispy Chicken Sandwich. The main course. Restaurant Brands International has done $8 billion of revenue in the last 12 months. This is up from $6.5 billion of revenue from the year 2 years prior. This left the company with $1.3 billion of net income, which is up from $1 billion from 1 year prior. The company reported EBITDA of $2.5 billion, which is up from $2 billion from 2 years prior. This represents 23% revenue growth, 30% net income growth, and 19% growth in EBITDA. If we take a look at the company's balance sheet, which is kind of weird because it's not showing the most recent stuff, just the annual report from 2023, so I'll look at the most recent quarter. The company reported $25 billion of assets, which is up from $23.25 billion in 2022. Liabilities came at $20 billion, which was up from $18.5 billion 2 years prior, and this left them with a shareholder equity of $5 billion, which was also up from $4.2 billion from 2022. The company currently has a total debt of $16 billion, which is up from $14.5 billion from 2022. If we take a look at the cash flow statement, we can see that in the last 12 months, they have reported cash flow of $1.25 billion. This is down from their 2022 numbers of around $1.4 billion. In this time period, the company has bought back a lot of stock, with the last 12 months them buying back $385 million worth, in 2023 $500 million worth, in 2022 $326 million worth. As the company has bought back over $1 billion of stock in the last 3 years, you would expect to see a large drop in their shares outstanding. However, due to some of the acquisitions that they have recently done, their shares outstanding has only dropped from 464 million shares down to 454 million shares. In this time, the company bought back over $1 billion of stock, but the actual current market value of the stock that they have bought back is $800 million, as it's about the current share price, which is about $70 to $80, and the 10 million shares that they bought back. As you can see on the chart here, unlike some of the other companies we have reviewed, there is a green part on their net change in shares, which means that over this time period, they actually released more shares than they bought back. This was due to an acquisition that they did at the beginning of this year that I will get to later in the video. If we take a look at the Excel sheet for the dessert section of this video, we can review some of the stuff we have already discussed. The company we reviewed was Restaurant Brands International, which trades under the ticker symbol QSR. You might think this is kind of a weird ticker symbol because there's not a Q or an S in the company that we reviewed, but the QSR stands for Quick Service Restaurant, which is the industry term for a fast food restaurant. They are in the fast food industry. In the last 12 months, they have done revenue of almost $8 billion, EBITDA of almost $2.5 billion, and net income of almost $1.3 billion. The company holds on to $16 billion of total debt, $25 billion of assets, and $20 billion of liabilities. This leaves us with around $5 billion of shareholder equity, which is the highest we've seen of the other fast food restaurants we've talked about. In the last 12 months, the company has done $1.25 billion of free cash flow and bought back $385 million worth of stock. If we look at some of our ratios, we can see they have a debt to equity of 3.18, which is the best we've seen out of the fast food companies. They have a debt to EBITDA ratio of 6.48, which is not dissimilar to Wendy's, but still around twice the size of McDonald's. They have an EBITDA margin of 31%, splitting the difference between McDonald's and Wendy's. A net profit margin of 16%, again splitting the difference between Wendy's and McDonald's. A free cash flow or a buyback percentage of free cash flow of 31%, the lowest we've seen of the fast food companies. And buybacks as a percentage of net income at 30%, again the lowest we've seen of fast food companies. If we take a look at the comparisons, we can see they have a high debt to equity, which seems to be a common theme among the fast food companies, a high debt to EBITDA, but again a high EBITDA margin and a high net profit margin. As we can see from some of these franchise-based businesses, they tend to have a high debt to equity and a high debt to EBITDA, but that also comes with a high EBITDA margin and a high net profit margin. Due to some of these, I can't give them a green because they do have high debt to equity and they do have high debt to EBITDA, but just like McDonald's and Wendy's, they have high EBITDA and net profit margins, and so I cannot justify giving them a red light. So just like the other companies, they are going to get a yellow light. This is due again to the high margins for their EBITDA and net profit, because those cancel out their high debt to equity and their high debt to EBITDA. Those high debt to equity and debt to EBITDA seem to be the industry average for franchise-based businesses, but when it comes to all businesses within the S&P 500, they are higher than I would like to see out of somewhere I would like to put money. The check. The check is some of the drawbacks that we've seen, and it comes at the end of the meal. In this case, the meal was Restaurant Brands International, and the check is the recent acquisition of Carroll's Restaurant Groups. Carroll's Restaurant Groups was the largest operator of Restaurant Brand International franchises, as they owned over 1,000 individual locations. This came at 1,022 Burger Kings and 60 Popeyes. Carroll's Restaurant Group brought in $1.8 billion in the 12 months preceding the acquisition, and the company paid $1 billion in cash to buy it. This $1 billion of cash came from some of the shares that the company sold, which is why you saw that positive section on their shares outstanding graph. The reason that this is both a good and bad thing is that it's a good thing because it shows that the company has an initiative to buy back some of its struggling restaurants and try to bring them up. The bad news about this is the company is expecting to spend $500 million to remodel 600 of their acquired restaurants. This is a large portion of their free cash flow and some money that they could be using for dividends, buybacks, or debt repayments. This is kind of a bad thing because it's showing that Restaurant Brand International's businesses might bring in bad franchisees and franchise owners, and it might require the company to buy back some struggling franchises in order to try to increase the brand's image and public perception. The fact that the company had to spend $1 billion to buy back over 1,000 restaurants is showing that the company does not have much faith in its largest franchise owner, and if it can't trust its largest franchise owner, it likely can't trust some of the smaller ones as well. The final two videos of this series will be based around Yum Brands. Yum Brands owns businesses such as Taco Bell, KFC, and Pizza Hut. One of the fundamental differences between Yum Brands and some of the other businesses we have talked about in this series is that Yum Brands does not own its Chinese distribution rights. Yum China is its own publicly traded entity that was spun off due to falling same-store sales in the US and hyper growth in the Chinese market. Yum Brands was a spin-off of businesses bought by PepsiCo when they were trying to win the cola wars against Coca-Cola. In this, Pepsi decided to buy out fast food companies, hoping that this would convince those companies and others to start selling Pepsi products over Coke. This backfired as the other brands decided to go and use Coke products because they did not want to help their competitors, in this case what is now Yum Brands. I hope you enjoyed the video on Restaurant Brands International, and hope you will stick around for the Yum Brands and Yum China videos to see if the financial health between Yum Brands and Yum China are fundamentally different. Thanks for watching, and please join me in the next video.